Chapter 5, Cost Estimation. When managers make decisions, they need to compare costs and benefits among alternative actions, as we've seen in prior chapters. In Chapter 4, we talked about costs between alternative actions, but in this chapter, we're going to discuss how to estimate those costs required for decision making. Each method is a little bit different, and different methods give different results. So we're going to look into the strengths and weaknesses of each method. So in this chapter, we're going to cover 3 different methods to analyze costs. Now, one of them is fairly difficult, involves statistics, regression analysis, and some upper-level math. And really, the proper way to learn regression analysis is using and practicing with a graphing calculator. But we're not going to go in depth into regression analysis in this class. But I want you to at least be aware of the method. So if you end up taking a graduate level microeconomics or a graduate level cost accounting class, you will have to get deep into regression analysis. But for our level, we're not going to go too deep. We estimate costs because we as managers have to figure out what's best for the company. We look at different alternatives and we act accordingly. Remember that cost accounting is a little bit different from financial accounting, because financial accounting focuses on the past, focuses on books and records and what activities have been completed, whereas cost accounting has a future outlook. We take the data and we decide how to act based on the data that we have. So cost accounting, cost estimates are very important to managers, and helps them decide exactly how to act and how to direct the company to be more successful. In this chapter, we talk about fixed costs and variable costs again, same as the first 4 chapters that we've covered. As a reminder, remember that fixed costs is something like rent. That if we're in a relevant range, rent is not going to change. It's going to stay a fixed flat amount within our range of activity, so we don't really have to worry about that cost going up and down. We do have to worry that our activity is profitable enough to cover our fixed costs, but it doesn't affect our contribution margin. With variable costs, that's something like if you're reselling items, a variable cost would be cost of goods sold, something that goes up in proportion with your sales or your service activities. All right, so again, fixed cost is a fixed dollar amount for a period, and variable cost goes up and down depending on your volume. One thing to notice here is that total fixed cost, like I said, is constant. It doesn't change. But variable cost, the per unit cost is constant. Okay, so let me repeat that. Total fixed cost is constant, and per unit variable cost is constant. Okay, so again, the total for fixed cost doesn't change, and the per unit variable cost doesn't change. Okay, so keep this in mind if you are calculating, if you have a total fixed cost amount and you're given different different production amounts. Let's say you produce 10,000 units versus 20,000 units versus 30,000 units of whatever you're selling. The fixed cost per unit is going to change, right? Because if you have like let's say you have rent for your house or your apartment, and depending on how many people live there, the more people that live there, the more you divide that rent by. So so each person's monthly amount is going to change, right? But the monthly rent that the landlord's going to get, there should be the same amount. All right. So that's going to be your fixed cost, and then variable cost is going to change per person. So let's say you're going to the movies. One person costs $8 to get in. 10 people is going to cost $80. So the per person price is the same, but the total is different when you're talking about variable cost. So that's something to keep in mind. If a problem gives you a fixed cost amount, they usually give it to you in total amount. And then if they give you variable cost, they usually give it to you in per unit. But they might not. They might give you a total variable cost and ask you to calculate the per unit cost, and vice versa. So just be aware of how fixed cost behaves versus variable cost in your homework problems. As I said from the beginning, we're going to cover 3 different methods to estimate cost. You have your engineering estimates, your account analysis, and your statistical methods. These names, again, they sound kind of difficult. This book likes to use a lot of difficult terms, but we're going to go over them, and you'll see that they're actually not as hard as they might sound. The first method is called engineering estimates. Again, this term sounds pretty scary, but it's really not bad. The concept is that managers are going to identify activities like labor, rent, and insurance, and then estimate the time and cost required for each activity. So, for example, in the homework, we're going to have a problem that involves a home builder. And to build a home, you're going to have different kinds of costs. Some are going to be fixed, some are going to be variable. And so basically we're going to calculate cost of items. We're calculating the costs of items or products that include many subcategories of costs. All right, so for example, the book talks about a company called Charlene's Computer Center, I think, and they name certain costs such as repairs, utilities, admin support, supplies. So that's all it is. I mean, you're taking an activity and you're trying to break it down into smaller cost categories to be able to give a better estimate. All right. So again, the term engineering estimate sounds kind of intimidating, but really all you're doing is you're taking an activity and you're breaking it down into smaller pieces, into variable cost, fixed cost, and then breaking them down further into things like rent and utilities and supplies and administrative costs. All right. So one thing about engineering estimates is that it could possibly be based on prior experience. So if you're a house builder and you've built a few houses, you might come up with your engineering estimates based on those past amounts. For example, if you know that you have a certain number of plumbers or electricians or administrative support, secretaries, whatever the costs are, you already have experience from prior houses that you built, so you're going to base your estimates or engineer your estimates based on those past amounts. However, an engineering estimate might also be developed from the ground up with no prior experience, so they're just based on best guesses. So sometimes they're based on experience, but they don't have to. And so we're going to compare this to to our next method of cost estimation, account analysis. So in account analysis, so this is our second method. It's not as complex as engineering estimates, in which you try to come up with every single cost possibly related to a certain activity. With account analysis, you just break down costs into fixed and variable, like we've been doing in the past few chapters, and you adjust from there. So estimating cost using account analysis, that involves a review of each account and making up the total costs being analyzed. Then each cost is identified as either fixed or variable, depending on the relation between the cost and a certain activity. All right, so fixed costs are those that are fixed in total, like I said, regardless of the activity level. And variable costs are going to change as the activity changes. So if we look here at the graph, the two graphs, it doesn't matter if you let's say this the x-axis is the amount of units you're making, so it doesn't matter if you make 0 units or 1,000 units. Your fixed cost is the same. Let's give it an amount. Let's say it's $5,000. So if you make 0 units, your fixed cost is $5,000, or if you make 1,000 units, your fixed cost is $5,000. So again, fixed cost total is going to be the same. Variable cost, so this next chart, the chart on the right, shows something that's completely variable. So if you make 0 units, your cost is also $0. But then if you make 1,000 units, your cost here is, let's give it another amount, $5,000. So variable cost is going to go up based on the number of units, whereas fixed cost is going to stay flat. The total amount is going to stay flat no matter if you make 0 units or, in this case, 1,000 units. So here's an example of in the book of a company that it has costs for 360 repair hours. All right. So what they're doing is they're breaking down the cost of these repair hours, so that they have a bunch of different expenses: office rent, utilities, admin, supplies, training, and other. And so it gives you total amounts. So total office rent was $33.75, total utilities was $310, and so on. But from there, they break it into variable cost and fixed cost. All right, so we look at office rent here. In the past few chapters, we always talk about office rent as a fixed cost, right? And so this office rent is $2,000. But in the book, it tells us that for this example, we're saying that office rent has a revenue sharing clause in it. So what is that? The company, let's say the landlord cuts them a deal. They say, look, we're just going to charge you $2,000 a month for rent, but if you're you really should be paying $3,000 or $4,000, but we're just going to charge you $2,000 because we know that your business is struggling. But we also want a cut of any revenue that you make. So if your business starts picking up, then we also want to get a little bit more rent out of you. So in this case, the fixed cost was $2,000, and then they did enough business to generate extra rent. So the extra rent was $1,375. So if you add those two numbers up, you add $2,000 and $1,375, and you get $3,375. All right. So office rent in this case was mostly a fixed cost, but there was a variable cost to it as well. Utilities, we usually talk about utilities as being variable, but there is a fixed cost to it as well. Let's say, for example, you are traveling out of town for a month, or let's say 2 months to make it easy. So in order to save on your electricity bill, you unplug everything. You unplug you turn off your AC, you unplug your refrigerator, unplug all of your appliances and everything. When you get back 2 months later, what happens? You get your electricity bill in the mail, but it's not zero. Even though you might have used zero energy for those 2 months, they still charge you a base fee just for having the electricity hooked up in your house. So I'm not sure exactly if this is the case, but it's a reasonable assumption or explanation as to why utilities has a fixed cost and a variable cost. Admin, that can be something like a supervisor, and so a supervisor, they're going to incur their salary as a fixed cost, but maybe this variable cost represents an extra secretary. Maybe they were inundated with paperwork one month and they needed some extra help for admin. And the same thing goes for supplies, training, and other. Again, they're breaking down these numbers into a fixed cost and variable cost, and then from there they total up fixed cost. It adds up to 6,216, and then variable cost is 4,410. So to get to 1225, you just take your 4,410 here divided by your 360 hours, and you get $12.25 per repair hour. So now that you have your fixed cost and your variable cost per unit, now you can use those numbers and use it to estimate cost at different levels of repair hours. So to check our math, for the 360 repair hours, we take our fixed cost, which was 6,216. We add the variable cost to that, and the variable cost is the repair hours, the 360 repair hours, multiplied by the 1225 that we calculated on the prior slide, and we get a total cost of $10,626. Now, these managers look like, or they believe that business is going to pick up in the next month, so they think that there's going to be 480 repair hours. So from there, you can just plug in 480 into the formula. Your fixed cost is the same. Remember, your total fixed cost is the same no matter how many units you produce. Your variable cost per unit stays the same, but your number of repair hours increased. But you just plug in this new number into our formula, and you get $12,096. So again, first thing you do when you have an account analysis to do is you take your costs, you break them down into fixed and variable costs, then you find out what your variable cost per unit is, and then you can plug in different levels of activity using those numbers that you calculated. Now, the third method we're going to talk about is statistical analysis, or statistical cost estimation. So what we do here is we look at costs within a relevant range, and then we plot it. We take the data and we plot it, and we can do different things with it. There's not a one single set way to use statistics, and even in this PowerPoint, we're going to talk about a couple of different methods. We're going to talk about the high-low method and regression, and using a scattergram. So there's a couple of different ways to use statistical methods. So we're gonna go over those right now. So let's take a look at this example. In this example, this business created a spreadsheet of overhead costs for the last 15 months. All right, so let's take a look at this spreadsheet. Generally, it looks like the higher the number of repair hours, the higher the cost, right? So, like, let's see, here's 200 repair hours, which I think is the lowest on the list, and overhead cost is 9,000. 212 is also pretty low, and overhead cost was 84.64. So it's actually a little bit less, but still close. And let's take a look at the high end. It looks like the highest number of repair hours is 544, and overhead cost is 13,269. So repair hours increased a lot, and so did the overhead cost. So that makes sense. So generally, it looks like the higher the repair hours, the higher the overhead cost. But not all the time, because let's look at months 1 and 2. Months 1 and 2 repair hours were both 248 hours, but as you can see, overhead cost in one month was 98.91, and in the other month was 92.44. So it was roughly a $700 difference with the same number of repair hours. So again, it's not strictly proportional, but I think if you if we look at each month, we see somewhat of a pattern there. So you can take the data from the prior slide and put it onto a graph, and it would look something like this slide. So again, looking at the numbers from the prior slide, we could tell that generally speaking, the amounts went up, right? When repair hours went up, the monthly overhead costs went up as well, and so there's somewhat of a line going through into the scatter graph. We can draw a line through. So it looks like the relationship between repair hours and overhead costs is generally a positive relationship, where as repair hours increases, so does manufacturer overhead cost. So here's a line that's a little bit more accurately drawn than the line that I just drew. But in this case, the book is saying that we're eyeballing the line. We're trying to draw as straight of a line through to these data points as possible, and then we can kind of see a trend and a relationship between the numbers. So in this case, the slope of the line would be the estimated cost per unit, and then the y-intercept with the vertical axis would be the estimate of the fixed costs. So it looks like here fixed cost, if we draw a line here, fixed cost is probably, what is that? Let's just say it's around $6,500. And then to do the slope, we'd have to do a little bit of math there. But you can see that the slope is going to be positive, right? Because positive slope increases from left to right. But as you can imagine, when you're doing a scatter graph and you're preparing an estimate based on this line that you eyeballed, you know, it is subject to error, a high level of error. So So a lot of times scatter graphs aren't used by a lot of people since they can be erroneous. But you know, it depends on how strict or how accurate of an estimate you need. As we talked about before, when you're doing cost accounting, you're projecting into the future, and that's inherently inaccurate. There's going to be errors in your predictions and what actually happens. So for some people, scatter graphs are good enough, and for others, they want something a little bit more accurate. And we're going to look at that when we talk about regression analysis. So when you're eyeballing this line, it looks like they did a pretty good job to draw this line. The idea is that you want to draw a line through all the dots, and ideally half the dots would be above the line and half would be below the line. So in this case, it looks like we have 1, 2, 3, 4, 5, 6, 7 dots below the line. We have roughly 1, 2, 3, 4, 5, 6, 7 dots above the line, and then this dot right here is pretty much the line went straight through that dot. So it looks like they did a good job of eyeballing this amount, 7 dots above and 7 dots below. So it looks like for an eyeball type of estimate, it looks pretty good. Well, before we get into regression analysis, the slide PowerPoint leads us to high-low cost estimation. So this is another way to estimate costs. It's fairly straightforward. You take your the highest amounts, compare it with the lowest amounts, and you calculate the change. So in this case, they're actually using the same data that we looked at a few slides prior. So on this chart, we identified, I believe it was 200 as the lowest amount of repair hours, and that cost was $9,054, and then the highest looks to be 568, and the cost for that is $12,883. So we take those numbers and we calculate the difference. So the difference between overhead costs between the high amount and the low amount is $3,829, and the difference in those repair hours is $368. So from there, we take the dollar amount, difference between the highest and the lowest amount. We divide that by the highest activity level minus the lowest activity level, and we get variable cost. Okay, and we'll apply numbers to this on the next slide. But again, you take your the costs at the high and low levels divided by the activity level of the high and low levels to get variable cost per unit. Then you can apply this variable V to different activity levels. So if you take your variable cost, multiply it by the highest activity level, or you could take the lowest activity level, and whatever you do, it's going to come up with the same amount, or roughly the same amount, you know, with a little bit of rounding error. But we'll see that in the next couple of slides. So here's what it looks like when we put the numbers into the formulas. So we calculated this already 2 slides ago. We took the overhead cost at the highest level, subtracted it from the lowest level, and we got a difference of 3829. And let's see. So here the change we calculated was 3,829. All right, and then the difference between the hours, 568 minus 200 is 368, and that was the same as this slide, 368. So again, we've seen these numbers before. Now we're seeing exactly how we calculated them. So we're going to take the change in the overhead cost divided by the change in activity level, and we come up with $10.40 per repair hour. All right. So from there we can figure out what fixed costs are. So the way we do that is we take our cost, our variable cost, subtracted from the variable cost per repair hour, and we get 6,976. Now the difference between this formula and the bottom formula is that we're using the different levels. All right, so this one was the high month, and this one was the low month. Okay, so again, in the high month, the total cost was 12,883, and then the total cost for the low month was 9,054. And then so whenever we're trying to figure out fixed cost, we just take the total cost, subtract out the variable cost, and we get the fixed cost. And we can do that with the numbers from the high month, or we can do it with the numbers from the low month. So we're just taking, again, we're taking the total cost minus the variable cost, and that's giving us the fixed cost. Okay, so remember, total cost equals fixed cost plus variable cost. So so all this is we're taking this formula and we're removing some of the numbers around, but the formula still works fine. Just make sure that you use the right arithmetic signs. Remember, whenever you're moving a variable from one side of an equation to another, you can change whatever you're using. If you're using addition, you might have to use subtraction, and vice versa. But as you can see, your fixed cost number is the same, 6,976. If you use the high month numbers, or 6,974 if you use the low month numbers. But as the slide tells us, that's a rounding difference. $2 difference, when you're talking about $7,000 is really not a big deal. But this again illustrates that the principle of the high-low method, and then you can apply the numbers, the change numbers to either the high month or the low month to get your fixed cost. So now that we have fixed cost of 6,976 and variable cost per unit of $10.40, you can plug those figures into the formula for different activity levels. So here we're asking about 480 repair hours. We're using the fixed cost that we came up with. We're using the variable cost per unit that we came up with, multiplied by the 480 repair hour activity level, and we get a total cost of $11,968. So the high-low method is pretty easy to use. It's not that accurate because you know, your high month or your low month could be an anomaly. Maybe you did a little bit better than you usually do, or a little bit worse, and of course that'll throw off everything. But it's an estimation, and as we know, estimations aren't going to be completely accurate anyway. So for most companies, a high-low method is probably good enough. So now we get to regression analysis. And as the slide says, a regression is a statistical procedure to determine the relation between variables. So we're looking at the data points, and we are coming up with a line. Now, the line that we drew a few slides ago, we used the eyeball method, where we tried to just freehand a line to fit through the data points. But in your upper level classes, you're going to actually learn how to draw a regression analysis line accurately with algebra and a little bit of stuff that you probably learned from statistics and trigonometry. When you're doing a regression analysis, you're doing something that's related to the high-low method, but the biggest difference with the high-low method is that you're only using 2 data points in the high-low method. You're using the high month and the low month of activities, whereas when you do regression, you're using all of the data points. So in this case, if we're using the chart and we want to do a regression analysis, then we would plot all 15 points on a chart and then mathematically calculate the line to draw through it. And this is something that you will do on a graphing calculator in a future class if you pursue your master's or your bachelor's degree. Your graphing calculator is going to be able to take the points, all 15 points, put it, you plug them in, and then it will calculate the line for you. Now you should know what it's doing and understand the reason why the line is calculated and how it was calculated. But it is nice to use the graphing calculator to do that sort of work for you. So here's the formula for the regression equation: y equals a plus bx. It's similar to the formula that you probably remember from school, which is y equals mx plus b. It uses different letters, but the formula is the same when you're calculating a line and the slope. So in this case, y equals the y-intercept plus the slope times the number of units. So again, it's the same formula that you learned back in 7th grade, but it uses different variables and it moves things around. So instead of saying mx plus b, you say a plus bx. So this is the equation you use when you're doing regression. The one we're going to use, remember, is just total cost equals fixed cost plus variable cost. That's the one that we're going to concentrate on. But again, I want you to be at least aware that what a regression equation is. If you ever hear that term in the future, you'll know what we're talking about. And also, when you take your classes at the graduate level, you're going to get to work with this equation. So as I've mentioned, regression analysis is generally the most accurate. You plug in the numbers into the graphing calculator, it generates a line for you. So it's going to be more accurate than eyeballing a number, and it considers more data than what the high-low method considers. But it also does have its own issues, and we're going to talk about each one briefly. So one issue is that lines might not be linear. So whenever we're drawing these regression lines, or whether we use the graphing calculator or whether we eyeball it, we tend to draw a straight line. Sometimes costs don't go in a straight line. Costs can go in a squiggly line like this one. So it went up and then down and then back up again. So costs like that, it can happen because costs aren't always linear. You know, if you're producing close to the capacity of your factory, maybe the capacity of your workforce, you might have to add more overtime hours, or special rent some equipment, or do a temporary lease on extra factory space. So sometimes it costs a lot more than an incremental change whenever you're producing at certain amounts. All right. So sometimes, like I said, sometimes lines are going to be linear, like this one. Sometimes they're not. Sometimes they're going to be more curvy. And so in a case like that, where in real life the line will be curvy, but you apply a straight line, of course that's not going to be a very accurate way to estimate future costs. Because as you can see here, even in the even in this chart, there's a lot of problems between the two different ways to estimate, right? Because look, at point 0, if we're making 0 units, this dotted line here shows that we also have 0 cost, whereas our straight line shows that we have a fixed cost of a little bit over $300, which is not correct. And then if we look at the far end of the chart here, looks like once we approach around a volume of 40, our regression line indicates that, what is that, about a $550 of cost, whereas in reality it's more it's around $800. So again, just be aware of the issue. Sometimes costs aren't linear like we do in the books. You know, we always do linear lines in our homework because that's the simplest way to go. But in real life, they're not always linear. Another issue when dealing with the regression lines is that sometimes you have outliers. Like for example, in this chart, we have this outlier down here that doesn't quite fall into the area where the other dots are falling. So that would be, for example, like if a student constantly makes 95s on their homework, their tests, something like that, and once in a while they'll score 100, once in a while they'll score 90 and 89, whatever. But generally speaking, they score an average of 95. You can use that data to predict their next homework or their next test is going to be around 95. Now, if that student had a really, really, really bad week and scored a 60, well, that's going to take the average, that student's average is going to fall for the semester, but it doesn't change, or it shouldn't change, what your prediction would be for that student's performance for the upcoming week, right? Because if a student is making 95s year after year after year, 1 week they make it 60 or 50 or whatever. I think it's a safe bet to say that they're going to start scoring, or they're going to continue to score 95 for the foreseeable future. But what that does is it ruins, it'll lower that student's average, and in the same sense, it messes up a regression line. So in this case, if we're looking at the dots here, where looks like there's I think there's 15 dots on this whole screen, so 14 of them follow this line. So so this would be the real regression line here to follow the pattern. This is the line that we want to pay attention to. But the problem is, because of the outlier, when we plug in these 15 dots into our graphing calculator, this outlier is going to be figured into the calculation, and so the graphing calculator is going to give you this line. You see, so it's a completely different line from the first line because of this outlier. So that's another thing to be aware of whenever you're doing regression lines. An outlier can throw something completely off. So depending on what your homework might tell you to do, you might try to leave out that outlier in order to have a more accurate regression line. Again, we're not going to deal with the regressions in this homework or in this semester, but just be aware of the issue and understand that outliers can completely mess up your calculations. Another issue with regression lines is called the effect of spurious relations. Again, I don't know why this book uses a lot of difficult terms, but spurious, all that means is false. Okay, it would have been much simpler if they just put the effect of false relations, but they use the word spurious, which is not incorrect, but something that people don't use in everyday speaking. But anyway, what this means is that there's sometimes people look for relationships that aren't really there. Okay, so what does that mean? Let's take, for example, an athlete. A lot of athletes are superstitious, so they'll eat a certain meal, listen to a certain song, etc. before a game. They think that there's a relationship there between what they do before the game, like listen to that song or eat that meal, with how they perform. So I don't think there's any real data out there that can prove that, you know, if you wear a certain color sock or if you eat a certain food before a game, then you get lucky and you perform better. And I think that if a lot of these athletes actually tracked what they did, you know, every time they ate that meal, did they actually win, I think that they would find that there's not really a relationship there. But they try to they have an idea of this relationship in their head, and they continue to follow it. And again, that same mistake can be done in a regression formula. You think two items are related. In this case, we're talking about repair hours and cost. We think that they're related, but actually in more complicated regression formulas, you might have 4, 5, or 6 variables, not just the 2. You might be dealing with several variables, and you try to find a relationship between all the variables, but really sometimes there's not a relationship. Sometimes costs can act opposite, or can act the same, or just completely independent of what those variables do. So just be aware of that as well. Sometimes relationships are not connected. There's not a relationship between two numbers all the time. Now this slide illustrates the variable cost that was calculated by different methods that we talked about, the count analysis method, high-low method, and simple and multiple regression. A simple regression just deals with the two variables that we discussed, and the multiple deals with many more variables. So let's take a look. It looks like here that some of the estimates are pretty close. Like the count analysis gives us $12.25 per repair hour. Simple regression gives us a little bit of a higher amount, but pretty close. The high-low method, as we talked about, can be inaccurate, and it seems inaccurate here. Remember, for the high-low method, you're just looking at the high month results and the low month results, and you calculate the difference between those. And then you have multiple regression here. It gives us a base amount of $8.61 per repair hour, and then you also add 77% of parts cost. I'm not sure exactly how accurate that is or how close it can be to the simple regression or account analysis methods, but again, the purpose of this slide is just to show that depending on what method, what estimation method you use, you can come up with some pretty drastically different amounts. And then finally, we're going to talk about learning curves. So this can kind of explain why some lines might not be completely a straight line like we talked about. You know, it could curve. You could have a nonlinear cost line that will curve like we saw, or you could have a straight one, but a lot of times they're not. In real life, they're going to have some sort of curve to it. And one of the things you might be able to attribute to it not being a straight line, maybe one thing to consider is the learning curve. All right, so let's take a look at this chart here. It says that it doesn't tell us what we're producing here, but it tells us that to make unit number 1, it took 100 hours. And then to make the second unit, it took 80 hours. To make the 4th unit, it took 64 hours. And to make unit number 8, it took 51.2 hours. So it looks like here, every time you're doubling it, you know, 1 to 2, and then 2 to 4, and 4 to 8. So you're going from unit number 4, excuse me, to unit number 8. And here it's telling us that the assumption is that each time the number of hours for the next unit from 1 to 2 is 80% of the first amount, and then going from 2 to 4 is 80% of the second amount. And then going from 4 to 8 is 80% of the prior amount. So learning curve, again, implies that the more you do something, the easier it gets and the more experience you have, so you can work faster and faster. When you're charting the learning curve, you are saving money because first, it cost you, it took you 100 hours to do something, then 80, then 64, then 51.2. So there's a pretty drastic drop at let's say the first 8 units, but then when it gets to a certain point, it's going to start tailoring off, and the improvements. There are still going to be improvements, but they're not going to be as drastic as the first few. So here, from the first to second unit, we dropped 20, right? 100 to 80 is 20. Then the second, from 80 to 64, what is that? 16. And then 64 to 51, that's roughly about 13. So again, the improvement starts slowing down. You know, it can't keep going forever. it's gonna taper off at some point. All right, question number 1 in the homework. Again, if you haven't worked your homework, go ahead and try to do it first, so you'll get the most out of this video. I'm actually taking an online class myself right now at my work. I work at the IRS. I audit employee plans, and I've tried it both ways. I've tried to take my class without reading ahead of time, and those classes are just terrible. I mean, I fall asleep and I can't pay attention, and I don't learn anything. But the times where I do read ahead and read the materials beforehand, and then I use the class time and the video as a refresher, then I'm really prepared for the upcoming test, and I do really well. So from my experience and from what I hear from students, the best way is to always work. If you're given the materials ahead of time, given the homework ahead of time like I do for you guys, do that first before watching the video. But anyway, so question number 1, we're dealing with the home builder that I mentioned to you earlier. It says custom home builders designs and constructs high-end homes on large lots. It's developed several formulas to quote jobs. It includes materials, labor, other costs, and also they have different costs for different regions. And then it gives us some data here, and it says that this is for the Midwest region. All right, so the numbers it gives us here, it says that there's administrative costs of $20,000, and then there's building costs depending on what kind of house we want. If we want a basic house, a moderate house, or a luxury house, it's either $90 a square foot, $150 a square foot, or $225. Also, there's an amount for appliances. So if you have a basic house, a moderate house, or a luxury house, appliances are going to cost different amounts. And then there's the utilities cost, and that's $40,000. So the question says that a customer has expressed interest in having having CH, Custom Home Builders, build a moderate house and have it a 3,000 square foot home, which does not have utilities. So based on the engineering estimates above, what will such a house cost to build? So again, they're using this term engineering estimates. All it is they're breaking down how much it's going to cost to build a house into different categories. I don't know why they call it engineering estimates, but again, it's not a hard concept. So let's look. Administrative costs. So that's going to be the same. It doesn't matter how big of a house you build, or the level of luxury, whether it's basic, moderate, or a luxurious house. It's going to be $20,000. Building costs, that's going to change. So the question says that we're doing a moderate house, so that's $150 per square foot, and we're building a 3,000 square foot house. That gives us $450,000. All right. Appliances. It's going to come with appliances. We don't have to calculate anything here. It just tells us for a moderate house, appliances are going to cost $25,000. And then utilities. It says that the land does not have utilities already, so you're going to have to add it, and it tells us that utilities is going to cost $40,000. So you add all that up, 20 plus 450 plus 25 plus 40, and you get $535,000. So that's your answer to question number 1. Fairly straightforward, I would say. And again, this is an example of an engineering estimate. All right, question number 2. We have the records for Portland products. We have amounts for direct materials, which is $315,000, direct labor of $262,500, and variable overhead for $231,000. And it tells us that these amounts are for making 150,000 units. It also gives us a fixed manufacturing overhead of $270,000. The question says that this upcoming year, direct materials is going to go up by 20%. Direct labor goes up by 4%, and fixed manufacturing goes up by 10%. And the variable manufacturing overhead is going to stay the same, so that's nice. And then the question says, prepare a cost estimate for a volume level of 120,000 units of product. Okay, so it looks like we're dealing with 2 issues here. One is rising cost, direct materials, labor, and fixed manufacturing overhead is all of those costs are going up. And then the second issue here is that the volume is going down. We're going to make 120,000 units is what we're predicting, and we made 150,000 last year, so that's 80%. So if last year was 100%, this year we're only making 80% of that amount. All right. So that's quite a big drop there. So let's see what they want us to do. They want us to calculate a cost estimate. So we can go ahead and do that. Let's begin. For direct materials, it tells us that our last year's cost was $315,000. Direct labor is $262,500. Variable overhead was $231,000, and fixed overhead is $270,000. So these were our costs last year. Add those up, and that adds up to $1,078,500. And so if you divide that by 150,000 units, you get $7.19 per unit. So this is actually the answer to part B. The first box in part B, the cost per unit for last year, $7.19. But now we have to calculate this year's costs. So the first thing we're going to do is figure out what, we made 150,000 units last year. How much would it have cost us to make it this year? So all we're going to do is multiply by 1 plus the increase. Okay, so for direct materials, it tells us that direct materials is supposed to go up by 20%, so we're going to multiply by 1 plus 20%, so that's 120%, and that gives us $378,000. Direct labor, the question tells us that, let's see, it goes up by 4%, so 1 plus 4% is 104%. That gives us 273,000. Variable overhead. Now this, the question says it's going to stay the same. So staying the same is the same as multiplying by 1, which is the same as multiplying by 100%. And so that's going to be $231,000. And then fixed overhead, it tells us that it went up by 10%. So we multiply that by 110, 110%, and we get 297. All right, so it cost quite a bit more than it did last year to make the same amount. Let's see how much that adds up to. So if we had made these 150,000 units this year instead of the last year, it would have cost us over $100,000 more to make the exact same thing. So prices definitely have gone up, right? But we can't stop there. It tells us that again, last year we made 150,000 units. If it said, well, what if you make this 150,000 units this year? How much are you going to spend? Then that would be our answer: $1,179,000. But it doesn't tell us that we're going to make 150,000 units again. It says that we're going to make 120. So how do we handle that? All right, so I cleared up the board a little bit. So again, the numbers that we came up with were for 150,000 units, but we're only going to make 120. So what we can do is we can either multiply by 80% each one, so 378,000 times 80%, that gives us 302,400. We can do 80% for each one, or we can do multiply by 120,000 units over 150,000 units, and that's going to give us the same amount. Remember, because here, remember, 120 over 150 is the same thing mathematically as 80%. So however you want to write it, it's going to be the same thing. So 273,000 times 120 over 150, that's going to give you 218,400. And if we do the same thing here, it's going to give you 184,800, and then 297. So that total is going to be 1,002,600. And then you divide that by 120,000 units, and you get $8.36. So this $8.36, that goes in Part B. All right, so so again, Part B, last year's amount was $719. This year's amount is $836. So both amounts are going to be used for Part B. Question number 3. Oak Island Amusement Center provides the following data on the costs of maintenance and the number of visitors for the last 3 years. All right, so 1 year there was 1,825 visitors. It cost $2,925,000. The next year was 2007 visitors at a cost of $3,225,000. And then the third year there was 2,375 visitors. Actually, it says by the thousands, so that means 2,375,000. And the maintenance cost was $3,750,000. So it wants us to use the high-low method to estimate the fixed cost of maintenance annually and the variable cost of maintenance per visitor. So we have to figure out fixed cost and variable cost. So let's see. So to do the high-low method, we look at the high year and the low year, right? We're going to do the high maintenance cost minus the low maintenance cost. Divide that by the high number of visitors versus minus the low number of visitors. And so there's only three data points here. That's not too hard to figure out and to get right, or what's your high and low point. So it looks like here that the maintenance cost, the high is 3,750. And we're going to subtract that from the low maintenance cost, which is 2,925. We're going to divide that by the number of visitors, 2,375 visitors as the high number, minus 1,825 visitors. So when you do all of that math, you're going to get $1.50 per visitor. All right. So now that we have our variable cost per visitor, now we can go back to our trusty formula. Total cost equals fixed cost plus variable cost. So we can use this formula, or we can arrange it to the way they had it in the book. So we can do fixed cost plus variable cost equals total cost, right? So that's the exact same formula as the one I just wrote, except I flip both sides. But now I want to get the variable cost to the right side, so we're going to subtract variable cost here, subtract variable cost here. So now it's going to look like fixed cost equals total cost minus variable cost. So that's what the formula looks like in the book. So we can pick either data point. We can either pick the high data point or the low data point. Let me just go ahead and pick the high. With the high year, it tells us that total cost was 3,750. So we're going to put that here, 3,750. We know the variable cost is $1.50 per visitor. And for the high year, that was 2,375 visitors. And that's going to equal fixed cost. So if you do the math here, $1.50 times 2,375, you get 3,562.50. So you do 3,750 minus 3,562, and you get 187.50. Now that's not your final answer, because remember the question says that the maintenance costs were actually in the thousands. So whenever we were saying 3,750, we actually meant 3,750,000. So we're just going to have to add or move the decimal over by 3 spaces. So that's just going to give us 187,500. So that's going to be your answer to part A. Now, again, we use the data from the high amount, the high year, but you can actually use it for the low year. So if you want to, you can plug in the low year's numbers, the low year numbers. So instead of 3750, you can plug in 2925, and then instead of 2375, you can plug in 1825, and you're going to get the exact same answer. Part B says the company expects a record 2,600,000 visitors next year. What would be the estimated maintenance costs? So now that we have our figures for fixed cost, we know what our variable cost is, we can definitely calculate our total costs. Remember, the formula is total costs equals fixed cost plus variable cost. Fixed cost was 187,500. Variable cost, we know that was $1.50 per customer, and we're going to have 2,600,000 customers this year. So you do that math. You get 3,900,000 plus 187.5. So total cost equals 4,087,500. So answer to part B, what is your total cost for 2.6 million visitors? And that's going to be $4,087,500. That's question number 3. Question number 4, General Dynamics. It says that General Dynamics manufactures high technology instruments for spacecraft. The government plans to purchase 8 units, although it would consider buying 16 units also. And General Dynamics has a chart relating labor time required to units produced. It shows that to produce 1 unit, it takes us 10,000 hours. To produce the unit number 2, it only takes 8,000 hours. And to produce unit number 4, it takes us 6,400 hours. And it wants us to calculate the compute the labor time required to produce 8 and 16 units. So first we need to figure out what is the learning curve here. So in the book they showed different learning curves. They gave us percentages of 80%, 90%. We need to figure out what percentage to use for this question. So this question says that to produce a second unit, it only took us 8,000 hours, whereas originally it took us 10,000 hours. So that's 80%, right? So the second unit only took 80% of the time it took to produce the first unit. Now let's look at unit number 4. Unit number 4, it took 6,400 hours, whereas unit number 2 only took 8,000 hours. So 6,400 divided by 8,000, and again you get 80%. So It's consistent as you go down. Every time you double the amount of units, you also reduce the time, and the time to make that next unit is 80% what it was the prior level. So we're going 80% of the prior level. So let's see what how to get to the 8th unit and the 16th unit. So since the 4th unit is 6,400 hours, and we already know we're using 80%. The 8th unit is just 6,400 times 80%, and that gives us 5,120 hours. And then for the 16th unit, because remember you're always doubling, you double the whatever level you're on, you double that number to get to the next level. So to produce the 16th unit, you do 5,120 hours times 80%, and you get 4,096 hours. So your answer to produce the 8th unit, it took you 5,120 hours, and to produce the 16th unit is 4,096 hours. Part B, it says that assume that labor time is $125 an hour. Compare the cost of producing the 1st unit to the cost of producing the 16th unit, and what is the percentage of the 16th unit to the cost of the 1st unit? Okay, so the 1st unit, it took 10,000 hours, and it cost $125 an hour. So we spent $1,250,000 to produce the 1st unit. The 16th unit was 4,096 hours. It still cost $125 an hour, and that gives us $512,000. So that's quite a drop here. The 16th unit costs less than half of what it costs to produce that 1st unit. So to calculate the percentage of the 16th over the 1st, you just do $512,000 divided by $1,250,000, and you get 40.96%. So answer to B is what is the percentage of the cost of the 16th unit to the cost of the 1st unit, and that is 40.96%. All right, and then question number 5 is another question dealing with the learning curve, and it's the same thing that we just did. So I'm going to let you guys work on number 5 on your own. If you have any questions, again, feel free to contact me as always. And that's it for chapter 5. So your next test is going to be next week. It's going to cover chapters 4 and 5. Just go over your homework, watch the videos again, and make sure to work your homework until you can work them quickly. The test is going to be open book again. It's going to be very similar to test number 1 in with time limits and the number of questions. But again, it's open book, but don't use another human. You can use your notes, you can use your book, whatever you need. You can Google, but you can't use another human. you'll have a time limit, and I'll give you the password in the next couple of days. So make sure to study hard, and good luck on test number 2. Thanks.